Welcome back to the Financial Freedom Show. My name is Rob Berger. In this video, we're going to be looking at the differences between ETFs and mutual funds. In previous videos, I've mentioned that for long-term buy and hold investors, I don't see any reason that we need to bother with ETFs, that's exchange-traded funds. That sparked some emails and comments from folks wanting to understand why I believe that for most investors, all you need are mutual funds. So let's dive right in. And we're going to start looking at mutual funds, and then we'll turn to ETFs, and then we'll get into the differences and why I don't think ETFs are necessary for most of us. So I want to begin by looking at the Vanguard 500 Index Fund. It's what you see on the screen here. This is from Morningstar. And by the way, I've done a series of videos on Morningstar, which you can check out. I'll leave links below. But this is an example of a mutual fund. And one way to understand what a mutual fund is to understand the problem they were designed to solve. Because, if you go back far enough, mutual funds didn't exist. For example, when the stock market crash of 1929, mutual funds as we know them today didn't exist. You fast forward into the 60s, for example, and they became much more prevalent. And of course, today, very, very common. But what was the problem or the pain point, if you will, that mutual funds were designed to help us with, to solve? And it was a couple of things. If you think about it, before mutual funds, if you wanted a diversified portfolio, what'd you do? Well, you had to go out and investigate companies, investigate stocks, research them, research bonds, and go to the trouble of buying enough stocks and enough bonds to have diversity. It's very time consuming, very expensive, a lot to manage and to monitor. Of course, you could hire a broker, which many people did. And of course, that just added cost as well. And if we go back far enough, certainly before the Securities and Exchange Commission, there wasn't a whole lot of transparency into what these companies were really doing and how this all worked. And so mutual funds, the idea was, we're going to make it easier for investors. So rather than having to go out and research all these companies, you can just invest in a single mutual fund, or perhaps a few, and you'll get instant diversification. Your money will be divided up among hundreds, if not thousands of different companies, hundreds, if not thousands, in some cases, more than 10,000 different bonds in the case of a bond mutual fund. And it's all relatively inexpensive. In other words, it made investing easier for retail investors, that is, folks like you and me. Now, there are two kinds of mutual funds. You can sort of put all mutual funds into two categories. The first would be one that's actively managed. That is one where the management of the fund actually goes out and does all the research for you, figures out what they think are the best stocks and the best bonds, and then invests in those for the fund. And the other kind is called passively managed, or also an index fund. So those terms describe the same thing. And that's a mutual fund like, in this case, the Vanguard 500 Index Fund, where they don't hire a bunch of smart people with fancy degrees to figure out what stocks or bonds to invest in. They just track an index. And as you might have guessed, in this case, this particular fund tracks the S&P 500 index. And of course, there are many, many different indexes that can be tracked, both stock indexes, bond indexes, indexes like this one that focus on U.S. companies. There are indexes that focus on international companies. And so as a result, there are countless passively managed, or also known as index funds. And at a high level, that's sort of the universe of mutual funds and why they exist. And in fact, if we wanted to look more into this particular fund, and we looked at its portfolio, and again, this is through Morningstar, you can see that it owns quite a lot of companies, actually, in this case, about 500. And we can actually come down here and see the top 10 holdings. We could look at more, and we could look at quite a few. Many of these companies you're familiar with, perhaps some of them you're not. But by investing in just this one mutual fund, our money gets divided up among approximately 500 companies. Notice I said approximately. If you look right here, there are actually 508 holdings and 4 bond holdings. We don't need to get into why that is for an S&P 500 index fund, but the point is, with an investment in a single fund, you've got great diversity, in this case, among large US-based companies. Now, there's one important thing to understand about mutual funds. There are actually really two, and they're kind of related. The first is, if you want to invest in a mutual fund like our Vanguard 500 fund here, when you buy the shares, you're actually transacting with Vanguard. So you're giving Vanguard your money, they're in turn issuing your shares, and they're taking your money and investing it in the underlying assets of the mutual fund. Now that's very different than if you wanted to go out, for example, and buy a share of Apple. If you were going to buy a share of Apple through your broker, you would actually be interacting with some other investor. You wouldn't know who, but some other investor that wanted to sell. So it's a secondary market where you're interacting with other investors. With a mutual fund, you're buying directly from the mutual fund. Now that's going to become important when we get to ETFs. Now the second thing, and it's related, is the price that you'll pay. With a mutual fund, you always pay what's called the net asset value of the fund, or the NAV, N-A-V. You can see it here in the Morningstar website for the Vanguard 500 index fund. It says the NAV is $342.68. Now, one thing that's interesting about a mutual fund is that they trade differently than stocks. And I'm going to show you an example. I mentioned Apple. So let's come over here to Apple. This is also on Morningstar. Full disclosure, I own shares in Apple. So we're looking at Apple now. And you can notice down here, there's this red dot that's sort of pulsing, or I don't know, blinking, little circles, like a radar thing. And it's right above the 2P. Well, that stands for 2 p.m. Eastern Time. I'm recording this on a Wednesday at about 9 minutes after 2. The market is open, so any of us right now could log into our brokerage account and buy a share of Apple. And if we watch this long enough, in fact, it just changed a second ago, the price up here is going to change. Unfortunately, today as a shareholder, the price seems to be going down. It's not good, but in any event, it's currently trading at $121.98. And we could watch it here, and as long as the market is open, the price is going to go up or down based on who's buying and who's selling. We also see a bid and an ask, right? And if you're not familiar with those, a bid is what someone is willing to pay, an ask is what someone is willing to sell it for. And now, the difference between those two for some stocks can be quite significant. Not in the case of Apple, because it's traded so often. You can see the difference between the bid and the ask is just a penny. Oh, and there it just changed, still just a penny, but unfortunately, my investment in Apple just went down. I want to stop watching. The more we watch this, the lower my investment in Apple goes. But the point I'm making here is that when the market is open, the price of Apple is going to change. And when you put in an order, it's going to be at that market price. If I would have sold earlier today, I would have gotten more for my shares because it was up for the first roughly half of the trading day. If I sell it now, well, it's gone down. Now, if we go back over to the mutual fund, you notice we don't have any of that. We don't have that fancy chart showing us what time it is and that pulsating red dot and prices changing. What's up with that? Why is that? Well, it's because mutual funds aren't traded on a secondary market between investors like, say, a share of Apple. Instead, as I mentioned, you're going to deal directly with the mutual fund company. And if I wanted to either buy or sell a share of this fund right now, I could put my order in. I could log into my Vanguard account and say I want to buy whatever, 100 shares of the Vanguard Index Fund, VFIAX is the ticker. And Vanguard would say, that's terrific, Rob. We've got it. We've got your money. And here's what we're going to do. We're going to wait until the market closes at 4. Then we're going to figure out the value of all of the securities that this fund owns. When we have all of that, we're going to calculate a new NAV for this fund, net asset value, and then we'll sell you shares at that price. So if I'm going to buy this, I don't actually know right now what the price will be. I won't know until the market closes and the new NAV is set. That's how a mutual fund works. And I've kind of gone into those details because it's now going to help us understand the difference between mutual funds on the one hand and ETFs on the other. So let's turn to exchange traded funds, or ETFs. What you're seeing on the screen is a Vanguard S&P 500 ETF. Ticker symbol is VOO, or VOO. I don't know if people actually say VOO, but VOO. And this is an example of an ETF. And there's a lot of differences, but let's first talk about the similarities. And this is true generally of ETFs on the one hand and index or passively managed mutual funds on the other. First of all, just like a mutual fund, they can provide easy diversification. This Vanguard ETF, just like the mutual fund, invests in 500 of the largest U.S. companies. They're also relatively inexpensive. In fact, some are just downright cheap. And just like index mutual funds are, by and large, very inexpensive. So in that sense, they're very similar. But again, there are some differences, and they're important to understand. And I think the best way to understand them is to understand why ETFs exist in the first place. If they're so similar to index mutual funds, diversity, they track an index, they're low cost, why in the world do we have them? And the answer is that some investors want the ability to trade a mutual fund in ways similar to trading a stock. And as I mentioned, they can't do that, but they can with an ETF. An ETF is like taking a mutual fund, but giving it the ability to trade like a stock. So what does that actually mean? Well, the first thing is, just like the Apple stock we looked at a few minutes ago, this Vanguard S&P 500 ETF trades throughout the day. In fact, you see the same chart, you see the same pulsating red dot. You see the price there. It's currently $337.06, but if we give it enough time, that will change. It also has a bid-ask spread, just like the Apple stock did. So it trades very much and very similarly to a stock. And some, though, might say, well, that's great, Rob, but so what? What's that do for me? Well, for some investors who want to be able to do certain things, it allows them to short this. They can short this ETF just like you can short a stock. Or maybe there's folks that are really just itching to buy and sell options. And so they want to write call options on a Vanguard 500 mutual fund. Well, they can't do it, but they could on this ETF. Or maybe they want to buy and sell puts. So it allows them to do that. It also allows you to sell or buy the ETF at the price that exists right now, during the trading day. So if I want to buy this right now, you can see the bid ask. It's a very narrow range because, like Apple stock, this particular ETF is highly traded, very liquid. So I could buy it and I know what price I'm going to get, at least within a couple of pennies. If I buy the mutual fund, I mean, if maybe something crazy happens in the market over the next 2 hours and it just goes up by some crazy amount or down by some crazy amount. I mean, it is 2020. We've seen that this year where markets up by 10% or down by 10% in one day. And there are some, particularly institutional investors, that say, no, I need some precision here. I want to know exactly what I'm paying, or again, within a penny or two right now. And so an ETF will allow that. Now, all of that said, it may say, well, that sounds pretty good. Why aren't ETFs the answer? Well, a couple of things. For a long-term buy and hold investor, I don't think we need to short anything. I don't think we need to buy or sell, call or put options. I think that is certainly, for most folks trying to earn a few bucks, a great way to lose money. And so there's just, for most buy and hold long-term investors, we don't need the extra, I'll call them features, but put that in air quotes, that ETFs give us. And the second thing is, buying ETFs does add at least a little bit more of a headache because of this bid-ask spread. Now, again, in the case of this particular ETF, the bid-ask spread is not significant. It's what, at the moment, it's two pennies. For other ETFs, it can be much wider than that. We're talking dollars. I mean, it can be much more significant. And so why even bother with that? We could be buying this stock and paying more than its net asset value, that is the value of its underlying securities. When we sell it, we could be getting less than the NAV. Why do we want to mess with that if we can just go buy shares of the mutual fund that's identical in terms of the underlying investments? I just don't see a need for most long-term investors to bother with ETFs. Now, there's still more to the story, though. Let's take a look at these two together. So on the left, we have the mutual fund, Vanguard 500 fund. On the right, we have the ETF. And if we start by looking at the portfolio, and let me go to that now. The first thing I want to show you is that these funds are identical. If you go just down by the asset classes, they both have 99.04% of the fund in U.S. equities, 92 basis points in non-U.S. equities, If we come to the price earnings, let me just move that up here for both of them. The PE for both funds is 1959. The price to book is 3.17. Price to sales, 231 basis points. We can go on down the list. And in fact, if we look at the 10 largest holdings, we're going to see that they are identical. Sometimes you might see slight variations, but they're identical. And that makes sense. They're both tracking the S&P 500 index. But I wanted to show you that because it's not as if one of them is giving you some advantage or a different type of investment strategy. Just one's an ETF and one's a mutual fund. Now, if we go back to the quote page for both of these, some of you may have already seen this, but you'll notice that the expense ratio is different. This is the mutual fund, is 4 basis points. And this one over here is 3 basis points. So I suppose one could say, well, wait a minute, Rob, you're a big believer in keeping fees low. Every basis point matters. Yes, that's true. So why not get the ETF? It's not a big deal, 1 basis point, 1 BIP, but hey, why pay more? Well, 2 answers to that. First of all, you still have to deal with the bid-ask spread. It's not significant, but it's there, and that's going to offset it maybe a little bit. But the other thing we can look at too is performance. And my guess is that even with that 1 BIP difference, the performance is going to be nearly identical. And so we'll look at it here. So it depends what we look at. If we look at year to date, the mutual fund is actually off by 4 basis points. But in 2019, it actually beat the ETF by 9 basis points. It beat it in 2018 by 7. It beat it in 2017 by 2 basis points. And we could go on. The point, actually, it lost to it in 2016, beat it in 2015. At the end of the day, the performance is going to be nearly identical. Keep in mind, the performance factors in the expense ratio. So these are after fee performance numbers. They're going to be virtually identical. And to me, it just doesn't make sense to have to deal with the bid-ask spread, possibly paying more than the NAV when you buy, possibly receiving a little less than the NAV when you sell. I can simply interact with Vanguard with a mutual fund and know that I'm buying and selling all the time at NAV. And I'm never going to care about what time during a trading day that I'm selling or buying the shares. In fact, even when I'm buying stocks, I often buy them or place the order after the market is closed, so that I'm not influenced by the ups and downs of the daily variances in the market. I want to sort of withdraw from that so that my emotions don't get the better of me. Because there's just no need for long-term buy and hold investors to worry about whether they're getting the price that exists at 10:15 in the morning versus 2:30 in the afternoon. Now, having said all of that, I will concede that there are a few times when it may make sense for a long-term buy and hold investor to consider an ETF. So what are those situations? Well, the first is the required minimum initial investment. Most mutual funds have some minimum investment. If you see here, you can see that for the Vanguard S&P 500 Index Fund, the minimum investment is $3,000. In the case of the ETF, there is no minimum investment. Now, you do have to be able to pay the share price of $337. And actually, depending on what platform you're on, you might be able to buy partial shares. So this could be a hurdle for some. My view would be save up, in this case, the $3,000, even if it takes a while, and then invest. Or you could go to other S&P 500 index funds, like, for example, that Fidelity offers, that have 0 expense ratios and don't have a minimum investment requirement. That's another option. But I will concede that the minimum investment can be a hurdle for some folks. The ETF is one, but certainly not the only solution to that potential problem. I suppose some of you could be just itching to buy and sell call and put options on a basket of stocks and bonds. So you want to own ETFs to maybe sell call options, for example. Again, I don't think that's a good long-term strategy, but if you're out there, you can't do that with mutual funds. You'd need an ETF. The final reason is you could want exposure to certain very unique asset classes where you're going to have more options in ETFs than you will mutual funds. I've got a good friend who tries to mirror the allocation of capital across the world. He's got this ginormous spreadsheet with like 15 or 20 columns. And so he, for example, doesn't just invest in developed countries in one fund and then maybe emerging markets in another. He's got a China fund and an India fund and right down the list. And for that kind of investing, there could be some asset classes where, frankly, ETFs just give you the better option. So it's not the case that ETFs are never a reasonable choice for long-term buy and hold investors. I just don't think they are for most of us. Now, if you have already built a portfolio of ETFs, I'm not here suggesting you should sell it or that you've made a mistake at all. As I said, and as we've looking at Vanguard anyway, the ETFs and their comparable mutual funds are virtually identical. Certainly, there's no reason to make any changes if it's going to trigger any tax liability in a taxable account. But for those that are just beginning or thinking about this question, I think for most buy and hold long-term investors, the mutual funds are ideal. Now, one last thing, you will see in articles online and whatnot that ETFs tend to be more tax efficient and cheaper than mutual funds. When you see that, you need to make sure that you insert a word into that sentence. It's that ETFs tend to be cheaper and more tax efficient than actively managed mutual funds. It's not really true that they're cheaper or more tax efficient than index funds. I think at one point they might have been a little cheaper than index funds, but that's by and large not true anymore. And at least in my experience, the index funds that I've owned have been incredibly tax efficient. So there you go. That's my reasons for preferring mutual funds over ETFs for long-term buy and hold investing. It's not that ETFs are bad, and certainly there can be some reasons to own them. But by and large, they just add a level of complexity that, I don't think most of us need or want. If you have any questions, leave them in the comments below. I'll do my best to help you out. And until next time, remember, the best thing money can buy is financial freedom.